Welcome to today's market report.
Global share prices traded water on Monday as sharp falls in gold and oil prices and concerns over the spread of the Delta variant dented sentiment. US stock indexes were mixed at the close. The Dow Jones fell 0.3%, S&P lost 0.09%, Nasdaq added 0.16%. With the Delta variant spreading, money managers who were over-invested in the reopening trade continue to unwind that trade because it is not working right now, according to Bright Trading LLC. In Europe, gains in healthcare, utilities and technology stocks overweighed declines triggered by a fall in commodity prices earlier on Monday. The Pan-European Stock 600 index rose 0.2% to a close high of 470.68. MSCI's gauge of stocks across the globe shed 0.03%. Oil prices fell as much as 4%, extending last week's steep losses on a rising US dollar and concerns that new coronavirus-related restrictions in Asia, especially China, could slow a global recovery in fuel demand. US crude futures traded at $66.48 per barrel, down 2.6%. Brent was down 2.4%, ended at $69.04 per barrel. Gold slumped to a more than 4-month low as strong US jobs data bolstered expectations for an early tapering of the Federal Reserve's economic support measures. Spot gold dropped 1.9% to $1,729.09 per ounce. On the FX front, GBP/USD is trading a touch lower on the day, down 0.15% from a high of 138.94 to a low of 138.40. The markets are in consolidation and are still digesting Friday's jobs report. Non-farm payrolls showed that 943,000 jobs were added, and it was the largest gain in non-farm payrolls since August 2020. The US dollar is better bid on the back of the data, taking on the bears at fresh daily highs and resistance structure as measured by the dollar index. Fed hawks will have been emboldened by the data. It's worth noting that in the June dot plots, 7 FOMC members saw the first hike coming in 2022, while the median was 2023, analysts at Brown Brothers said, adding that if 3 members move forward their timing from 2023 to 2022, then the median becomes 2022. New dot plots will come at the September of 21st to 22nd meeting, and we think it's very possible that we see another hawkish shift there that will underscore that Fed tightening risks are rising. Meanwhile, US July inflation data will take center stage this Wednesday in the consumer price index, with headline expected to fall a tick to 5.3% year-on-year, and core expected to fall 2 ticks to 4.3% year-on-year. The PPI will be on Thursday. This will be the last key inflation readings until Jackson Hole Symposium to be held on 26th to 28th of August. Of note, the Fed's preferred measure of core PCE will be reported on 27th of August. The Jackson Hole will be keenly eyed for a more explicit tapering timeline from the Fed, which could lead to additional support for the greenback. If not, then the September FOMC meeting will be in high anticipation of an official tapering announcement. There has been so much tapering talk that the Fed probably won't wait long between the announcement and implementation, and so we continue to look for tapering before year end. Meanwhile, domestically, the pound has been under some demand following the recent Bank of England decision. However, the demand, at least in the spot market, has started to decay, with a fresh low printed today since the meeting, despite the rise in net longs. Sterling experienced a rise in net longs worth 3% of open interest, according to the latest CFTC data. GBP positioning is now fully neutral as the Delta variant spread in the UK is somewhat abating, and after profit-taking of shots heading into the BOE last Thursday, the Bank of England still offers a largely supportive underlying narrative for the pound going forward. Euro-dollar turned to the downside and printed a fresh monthly low at 117.40. The single currency remains near the lows under pressure as the US dollar holds on to gains across the board. The dollar index was up 0.18% near 93.
This is today's market news. Thanks for listening. We'll see you next time.